Jerome Powell laid the hammer on the markets, causing the stock market to fall. He caused the cryptocurrency market to crash, while mortgage rates have been rising because he said that the Federal Reserve Bank is going to stay aggressive to fight inflation and pull money out of the economy. How's he going to do it exactly? Well, he's going to be, quote, forceful to bring inflation down, even if that means that our economy has to go through, quote, pain. The side effects of these forceful actions by the Federal Reserve Bank are going to be, these are now according to the Federal Reserve Bank, first, a cooling in the labor market, aka layoffs coming ahead. Second, a cooling in the housing market, aka home prices falling. And third, a cooling in asset prices, aka asset prices, stocks and crypto getting hit. Couple that with all the new issues and concerns of gas prices rising again because of new potential concerns of oil supply risks. And now you can start to see where there's an issue, you can start to see what people have been selling, and you can start to see what people have been worried about what to do in the market. So if you're an investor and you're trying to figure out what the heck is going on and what you need to be doing, make sure you watch this video until the end. Now, if you really want to understand what you should be doing right now, the first thing you have to understand is how we got here, because you have to understand all the different factors that are coming together, because it's going to help you understand a bigger picture of what's actually happening right now. Because the issue right now, at its core, no matter which part of the economy that you're looking at, is inflation. Inflation is hurting all aspects of the economy because now that things are so expensive, now that rent is so expensive, groceries are so expensive, housing costs are so expensive, your vacation costs are so expensive, it's making it harder for people to be able to afford other things. So people are spending more money on things like groceries and rent and their mortgages and their cars, meaning they have less money to go out and buy things like extra guac and Chipotle, and this is causing an economic slowdown. Now, this economic slowdown is hurting businesses, it's hurting companies, and it's hurting people. But at the same time, this inflation problem is a separate but real concern because the inflation problem hurts our currency. So there's the currency issue, and then there is the economic issue. The Federal Reserve Bank is the central banking system of the United States. Now, they're called the Federal Reserve Bank. However, they're not federal. It even says so on their website. They're not a reserve. They don't keep cash reserves anywhere, and they're not a bank. You and I can't go there to deposit money. So while they're not a Federal Reserve Bank, they are the Federal Reserve Bank, and they get to control our monetary supply and our monetary policies. What does that mean? Well, they have the ability to raise and cut interest rates, and they have the ability to print money. So over the last couple of years, when the pandemic issue was going on, the Federal Reserve Bank worked with the government to print trillions of dollars. This is the most amount of money that we have ever seen printed ever in history. I mean, we have really made 2008 money printing look like a drop in the bucket, and this money was then injected into our economy. Well, all this money being printed had a consequence. Yeah, maybe you got some free stuff, you got unemployment checks, you got stimulus checks, businesses got big bailouts and loans and free money from the government, so money was flowing freely while nothing was actually being produced. Now, if you just think about that for a second, we are in a country where nothing was being produced except money. There's a consequence for that. I mean, if you can get $10,000, $20,000, $100,000 for doing nothing, why do we have to work to pay our taxes? Why do we have to work to pay off our mortgages? Why do we have to work to pay off our cars? Why can't the government just give us this stuff for free? Because there's a cost for it. That's the reason why if the government gave everybody a $100,000 check, everybody in America can't drive a Lamborghini because the value of your dollars would drop. This isn't a new concept. The Federal Reserve Bank has been around for over a century now, and since they've been created, we've been seeing inflation happen, and inflation disproportionately benefits the people who are investors, the people who understand money, and the financially educated, and it disproportionately hurts the financially uneducated and the poor. Now, it's unfortunate, but this is the reality, which is why you want to be financially educated. Because now when you understand this, you can use the system to your advantage instead of being one of the people that's just constantly being abused by the system. And by the way, if you're hearing noises around me, it's because I'm in Manhattan right now. That's why I have this layout around me. So if you like this layout, let me know. But just kind of a heads up on that with what's going on. So the Federal Reserve Bank has been printing money. This causes inflation. This has been happening for a long time. But now people are getting worried about inflation because of how high inflation is. And because now most people, regular people, are actually facing and seeing this inflation in their everyday lives, which is a new thing. And this is where now the Federal Reserve Bank is working to pull this high inflation out of the economy by pulling money out of our economic system. This is why you want to be an investor. This is why you want to be financially educated. That way you can benefit from what's happening in the system, because inflation is never going to go away. It might come down, but it's not going to be going away. This is where you want to be investing your money. That way you can get the benefits from inflation instead of just being the person who's paying the price. Now, what are these assets that you can be buying? This can be things like real estate. This can be things like stocks. This can be things like potentially cryptocurrency if that's something you believe in. You just want to make sure that if you are going down the cryptocurrency route, that you're using a good and reputable broker, and that you're not keeping your cryptocurrency in any brokerage, that you're taking your crypto out and you're putting it into a wallet. That way now your money is protected, your cryptocurrency is protected. If you're looking for a good cryptocurrency exchange or a stockbroker to use, you can check out our sponsor FTX US. I like FTX US first because their fees are very low. If you look at all the other major cryptocurrency brokerages out there, FTX US has some of the lowest fees in the industry. So now more of your money can be going to actually building your wealth instead of just making your cryptocurrency exchange richer. Second, they make it very easy for you to dollar cost average buy your cryptocurrency. So what does that mean? If you want to buy Bitcoin and you want to buy it once a month, or you want to buy it once a day, well, it's very simple to do that. You can just push a few buttons, and now every day, every week, every month, whatever you want, you can buy more of that cryptocurrency that you want. And third, now on FTX US, not only can you trade NFTs and crypto, but you can also trade stocks right off of their platform, and it's super simple to use. And the best part is that because you are a minority mindset follower, they will also give you some free cryptocurrency after you trade $100 worth of crypto on their app. All you gotta do is use my link down in the description below and then enter in the referral code minority. So if you use my referral link and then enter in that referral code, they will give you some free crypto after you trade $100 worth of cryptocurrency on their app. So the Federal Reserve Bank has produced this bubble through this money printing. Now this bubble is causing high inflation, and now in order to fight the high inflation, the Federal Reserve Bank needs to pop the bubble. How are they going to do that? Well, they can do two things. They can raise interest rates and they can sell off some of their assets. AKA, over the past number of years now, the Federal Reserve Bank has bought up a bunch of assets, things like mortgage-backed securities, things like treasury bonds. These were ways for the Federal Reserve Bank to print money and stimulate the economy, and they've built up this massive, now almost $9 trillion portfolio of assets sitting on their balance sheet. Meaning, they printed almost $9 trillion, bought up these assets, and now they're just sitting on their balance sheet, and so they can sell off these assets to help cool down inflation. And these are the things that they're working on right now. We have seen them raise interest rates multiple times in 2022. That's one of the reasons why mortgage rates have essentially doubled since the beginning of 2022. And last week, Jerome Powell, who was the chairman of the Federal Reserve Bank, committed to continuing with interest rate hikes. He said that the Federal Reserve Bank not only is going to continue with interest rate hikes, but they're going to stay forceful to bring inflation down, even if that means it's going to cause some sort of economic pain. Now, this is where things got very interesting, because this is something that he has not done before, because up until last week, Jerome Powell and the Federal Reserve Bank has always said that they will be willing to raise interest rates so long as it does not affect the economy. So they waited until 2022 to start fighting inflation because two reasons. First, they said inflation is not that bad. It's no real issue. Like we talked about this in market briefs, that a year ago, Jerome Powell did not feel that rush to start raising interest rates or start fighting inflation because he did not feel it was real. It was transitory. Now, he's really changed his course on that, where before there was no rush to fight inflation. Now he's working to raise interest rates to fight inflation because it's becoming a bigger deal. But the second thing, and the second reason that you want to pay attention to, is because now he even said that he's willing to do this even if there is economic pain. Because before, the whole idea was we will raise interest rates so long as inflation is there and so long as it doesn't hurt unemployment, so long as it doesn't hurt the economy. That was the big thing. And this is why so many traders kept pricing this into the markets that, okay, if we raise interest rates, it's going to cause layoffs. It's going to cause a slowdown in the economy. And so once that happens, once our economy slows down because the Fed is raising interest rates, then the Fed will start stimulating again because they're not going to want to see unemployment rates go up. They're not going to want to see people lose their jobs. They're not going to want to see businesses go under. But now he has a very different tone. He's now saying that the Fed is willing to do this forcefully, even if it's willing to cause economic pain. So what does that mean? He's saying now that even if unemployment goes up, even if businesses go under, even if stock prices crash, he's going to continue to raise interest rates because the number one goal is to fight inflation. They want to bring inflation back down to 2%, and they do not want to repeat what happened in the 1970s and the 1980s when inflation got even higher than what we're seeing right now. And so that's one of the things that he's trying to do. Now, will he stay true to that? That I don't know. That only time will tell. But this is the wordage that he used, which is very different than the kind of beating around the bush type of wordage that he's been using over the past number of months. This is why a lot of people have been getting scared, which is why people have been starting to sell. Now, if you're an investor, this isn't something that should really be shocking you, because the reality is this inflation problem is real. Whether you fight it now or you fight it in 6 months or you fight it in 10 years, it is real. The longer you wait to fight it, the more painful it's going to be. So you have to understand that the fight to bring inflation down from 8 or 9% to 2% is going to be painful. It's going to cause economic pain. It's going to cause pain to markets because that means you're going to have to raise interest rates, which slows down the economy. And so the question is, are we going to do it now or are we going to do it later? If we do it now, it's going to be painful. If we do it later, it'll be even more painful. So that's the first thing that you have to understand as an investor. The second thing is there's going to be a lot of volatility. We have so much emotion in the markets where people will panic and sell or panic and buy just depending on what words the Federal Reserve Bank says because of how much more accessible trading has become. Now, that is a good thing. More people have access to trading, but you have to understand that there's a lot more emotion involved because there's so many people talking about it on YouTube, on Reddit, and so many other places. And so these things can cause more emotion, and that's just one thing that you want to pay attention to. So now, if you are an investor, what does this mean for you? Well, if you're an investor, it really shouldn't mean that much. The main thing that you want to understand is you want to be looking for opportunities to buy a good investment at a discounted price. Because now if you're an investor, there's two different strategies that you should follow, and that's it. One could be a passive strategy where now every week or every month or every 2 weeks you pick. For the stock market, I do every week. For cryptocurrency, I do every day. But in the stock market, every Wednesday, money leaves my checking account and is automatically invested into my portfolio of ETFs. An ETF is a basket of stocks. And so now instead of investing in individual companies through my passive method, I'm investing in these ETFs. And this happens no matter what. Doesn't matter if the market's up or down. Every single Wednesday, money is pulled out of my account and automatically invested. And this happens all the time. This way, over the years, I can just accumulate more shares and more equity in the companies and ETFs that I want to own. The next is an active method, which is where now you want to find the good companies that you want to hold on to for the long term, that you believe in, but you want to buy them at a good price that you believe is undervalued. So what does that mean? Well, maybe you find some companies that you want to own, and now all you want to see is a good buy point. Where is a good price for you to come in and buy? Now, this requires more research, this requires more analysis, this requires more time. For 90 to 95, maybe even 98% of investors, this isn't for you. This should be for people who are willing to actually dedicate time and research into learning and investing their money. Because if you don't want to listen to earnings calls, if you don't want to study the financial statements, if you don't want to study what's going on and you just want to throw your money into random companies, now you're gambling, you're not investing. Investing requires more work, and this is where you just have to understand where do you want to be. If you don't want to put in that time, do the passive method into ETFs. If you do want to put in that time, well, now you can look at individual companies. When you find a company, go on sale because now the economy is getting hit, people are selling, and now this company stock price is getting hurt, not because the company is about to go bankrupt, but because the whole economy is hurting and is causing the price of your company to go down. This can create a good buying opportunity for you. And this is where you have to also understand that just as important as the financial education of what to invest in is the psychological education of knowing how to manage your investment, because so many people get caught up in the emotions of what's happening day to day. They're looking at their stock charts, they're looking at the stock price every single day because they want to see what's going on. But this is a very toxic way to be investing your money, because if you're constantly looking at the green and the red and the price movements, well, then when things go wrong, you're going to be much more likely to sell and abandon your strategy when you want to be a long-term investor. You were planning on holding it for 20 years, but you sold it after 20 days because of what happened in 2 weeks. When in reality, you want to be looking at it for the long term, not just the short term, because the real wealth is built as an investor over the long term, not just the short term, which is why you want to be able to block out the noise. And remember, what is your goal? Are you an investor or are you a trader? If you want to be a trader, fine. It comes with more risks, but just understand that's what you want to do. If you want to be an investor, great. But understand that means you don't want to keep the mindset of a trader. You want to be an investor. The only time you should be selling as an investor is if you find a better investment opportunity, or second, if something's actually wrong with your company, where now you're worried about what's going on, you don't like the investment anymore, now you get out, not just because the stock price fell. So this is where you want to actually understand what you want to be doing. That way you can pay attention to what's happening, because there's a lot of this X factor. I call it the X factor, where there's different things that can happen that can influence the markets that are out of the economy's control. What is this X factor? Well, the government and the Federal Reserve Bank. For example, let's just say that tomorrow the Federal Reserve Bank says, you know what? We're no longer going to fight inflation. We're going to cut interest rates. In fact, we're going to cut interest rates back down to where they were during the pandemic time. This is not very likely right now based off of what they said, but if they did that sometime in the next 12 months, 18 months, 24 months, what do you think that's going to do? It's going to cause a bigger bubble to form, because now everyone's going to want to put their money back into the markets, causing markets to crash, not downwards, but upwards. And this is where you can't control or really predict what the Federal Reserve Bank is going to do. So you want to understand what the Federal Reserve Bank is doing, but you don't want to be a trader who is trading their money based off of what they do. You want to find good investments and buy them at a good price if you want to be an active investor. But if you want to be a passive investor, you just passively keep investing your money and you keep letting the Fed and everyone else doing what they want, because you know that your strategy is going to build you wealth over the long term. If you enjoyed this video and you want to see why we might be entering a once-in-a-lifetime opportunity to build wealth and what you can do to capitalize on it, I already made a video covering it, and you can watch it by clicking that button right over there. Thank you for watching, and as always, keep hustling. When the 2020 pandemic happened, that was when the stock market and cryptocurrency was the biggest opportunity. Next time,